things have become a lot more accessible
Okay.
over this period of last 5 to 6 years especially. Still, again, like having that right set of connect, that right
Yeah.
set of advisor who can advise you while keeping in check what is best for your startup, what is best for
Mm-hmm.
you.
What are the common mistakes the founders are making right now while raising fundings? Once when we raise funding and everything, we'll be getting to know what is term sheets and everything once when we are signing up. But
Correct.
to the people who wanted to know more about the this funding life cycle and everything, if you can explain the term sheet, what does it mean and what are all the things which we have to
Sure.
look into it? So, welcome to High on Why podcast channel. I'm Naveen Prasad, your host, and today we are having Mr. Prince Awana as a guest. So, he is a corporate lawyer with more than 4.5 years of experience. He has handled 95 plus transactions across associating with VCs as well as the funding startups. And he has been also an advisor to multiple startups who has been wanted to raise an angel fundings till the private equity transactions. So, welcome to the show, Mr. Prince.
Thank you so much, Naveen.
Yes. So, to make it a bit more understanding to all the audiences who's watching this video, we'll be keeping this video into two perspectives. So, one from the founder's perspective and one from investor's perspective. So, let's drill down this video in this particular way so that they'll be having a better understanding. And I believe since you have been associated with VCs as well as the founders, you can clarify it much more better.
Sure, absolutely.
Okay. So let's jump into the questions.
Sure.
And first, we'll take down the founder's perspective.
Okay.
Since you have worked with many VCs and startups, the first thing which I wanted to ask is what interests you more in this space?
So, like one morning, I'm sitting down with a founder, helping him close $1 million raise from
Okay.
various sets of investors. While in the evening, I'm handling another founder and explaining him why his investors are looking for a liquidation preference.
Okay.
Like in one scenario, I'm looking to close the transaction. In another scenario, I'm just explaining him the very key basics of it,
I
as to
understood.
why and hows of the entire fundraising journey.
Okay.
So apart from where else, in which other sector would you come across a 21, 22-year old chap raising $5
Funding.
million
Yeah.
and building his own company, right? So it's the sheer unpredictability also that
Okay.
comes with it that keeps me exciting and
Exactly.
wants me to and keep working in this segment and keeps me hooked around that.
Okay. And right now, like the persons who are of age 21, 22, everyone is having starting their own startup, which
Correct.
is very much appreciable as well. And I have my own startup as well since you have been
Yes.
associated with me for a year now. If someone wanted to know about 0 to 100, like at the starting stage, right? So everyone is going through certain set of struggles. So where to go and raise the funding, whom to approach, and how do I keep my startup very compliant to the Indian rules and regulations, the governance and every policies. So if I start to look for someone who's going to solve for all the problems which right now or any founders who is going to face, as far as my concern or as far as my input, it's not very much accessible as of now.
Okay, accessibility, I don't see a major challenge over there. I think things have become a lot more accessible
Okay.
over this period of last 5 to 6 years, especially. But still, again, like having that right set of connect, that
Yeah.
right set of advisor who can advise you while keeping in check what is best for your startup, what is best for
Mm-hmm.
you, is of very much important, is of utmost importance for that matter.
Okay.
So once you have that clarity around your startup and once you're focused on building your own company and business, having the right set of advisors by your side is what is going to help you a lot in reaching from 0 to uh,
Exactly.
100 or 0 to 10 or
Yes.
even 0 to 1. In fact, if anything's reaching from 0 to 1 is very like critical,
Mm-hmm.
and that is what takes the maximum number of time.
Yeah.
Once you are there, then it becomes a little bit tad bit easier because
Yes.
now you know the flow, now you are used to various things, and you have like a half decent team by that time.
Yes. Yes. Yes.
So that is when it gets a lot more easier.
Yes, and many founders who have been watching this video will be having a doubt on what is Series A, what is Series B, what is seed funding, and especially founders who is from the Tier 2 cities or Tier 3 cities will be having this, will have to face this struggle, like to have a basic understanding. So if you can explain what is this process, like why that particular name has been given to each segments, and how we can approach them. Like,
Correct,
so
correct,
if you
correct.
can clarify this particular points, it will be good.
Absolutely. So, when it comes to various series of fundings, just to break it down and to make it simpler for the larger audience
Yes.
and for you as well, you can consider it in a way like modern dating,
Mm-hmm.
as to like there are certain levels.
Okay.
The very first is friends and family rounds. Then
Yeah.
comes the angel round, then seed round, and followed by a series A round.
Yes.
Okay, and then series B and beyond, of course. And in between also comes bridge rounds, right?
Mm-hmm.
So let's go one by one and deep dive a little bit into each of these rounds.
Yes.
The first one is friends and family round. This is where your family, like your mom, your dad, and
Yeah.
your siblings and your close knit friends are there for you.
Yeah.
So basically, they believe in you,
Exactly.
right? And that is where things get started. So just like how your school crushes,
Mm-hmm.
you don't have a clue what it is all about, but you're just there.
Yeah.
So you are still figuring out your startup idea, but you require that initial capital to get going, to get even started. That is where friends and family come into the picture. Friends and family round. Next comes the angel round. This is where things become start to become a little serious. That is once you have once you have high net
Yeah.
worth individuals or seasoned angel investors coming in
Mm-hmm.
looking to invest in you. These are those set of peoples or professionals who love taking big risks and
Got it.
are
Yeah.
looking for bigger rewards.
Mm-hmm.
So those people then start to come as a part of the investment round, and they start to invest in you
Yeah. So this is after the friends and
after
families you are
friends and
talking
family
about. Yeah.
round. And that after the angel round comes the seed round.
Mm.
This is where things have actually become pretty much serious
Serious.
now. VCs have started sniffing around.
Okay.
They are interested in you, and that is where things have become a lot more
Very
uh,
serious.
a lot more serious.
Yeah.
And this is where you can expect heavy load of paperwork
Mm-hmm.
and a lot of awkward conversations. So
Yeah.
this is where VCs would want to take you on a date
Okay.
essentially, and that is where the actual conversations and actual business would jump from.
Okay. Okay. Okay.
So that is where seed round comes into the picture.
Mm.
Then also comes the bridge round. So
Mm.
bridge round, what is a bridge round for? As the very name suggests,
Mm-hmm.
it is to ensure sometimes what happens is after a particular fundraising round, uh, company runs out of cash or is about to run out of cash,
Okay.
and they are still not there
Mm-hmm.
to raise Series A. They still have a lot of milestones to get completed, right? So that is where to cover that particular time gap of
Okay.
6 to 7 months or a few quarters, right? That is when they require extra money.
Understood.
And this bridge rounds are more often than not, almost every time
Mm-hmm.
happens as a convertible round.
Okay. Convertible loan
Yeah,
again.
so
Okay.
it is like you have been dating
Yeah.
and you would want to stall your engagement or marriage for a
Mm-hmm.
little bit more,
Got it.
right? So that way bridge rounds help you sustain for a little while longer so that you can
Mm-hmm.
reach to the next stage. That is
Okay.
series A. And series A is for the growth,
Mm.
like growth stage companies. You have your product market fit, your GTMs are sorted, you have built enough and more traction, and
Mm-hmm.
now you're looking to expand and grow your company further.
Yes.
That is where series A comes into the picture, where like the established VCs, not just micro
Mm-hmm.
VCs but established VCs, would invest in your company and would also expect like heavy returns.
Yeah.
And this is where essentially your board control also starts to get diluted a little bit.
Mm-hmm.
You might end up having the board control, but still it starts to dilute from here on
Okay. Okay.
onwards.
Okay. So after Series A, they will be having a say on our control and board
A
and
larger control, like,
okay.
see, friends and family, they believe in you
Yeah.
and not your idea. They
Exactly.
they are those people, like your that rich uncle.
Mm-hmm.
So he has invested in you. He doesn't really bother much about the business, the
Yes.
financials, the unit economics, or anything else for that matter,
Correct.
right? So but this, like, seasoned angel investors, seasoned like established VCs, they are going to have established steps and processes which
Mm-hmm.
you'll have to tick off every
Understood.
now and then.
Yeah.
Quarterly compliances, monthly compliances, MIS reports,
Got
all
it.
of those things that you'll have to keep working on.
Mm-hmm.
So this is where you will have to have your entire startup structured in a really robust manner.
Okay. And talking about this bridge round, right? For example, consider a founder has raised a Series A funding, and he has expended some certain amount of funding to be consumed in say X months. Consider 6 months to be precise. And if he has completed or exhausted all this amount within 3 months, is it possible to raise the bridge round, or how the VC's judgment will be on this particular thing? Because he has planned certain thing and couldn't able to execute that particular plan in a like effective manner.
effective
Yeah.
manner. No, that is like a big challenge, I would say. See, because essentially what is happening is once founders starts to raise, they very much needs to understand as to how much they are raising.
Yeah.
Right? It's not all about valuations. At the end of the day, essentially every time you are raising a round, you need to have a clarity around your runway.
Hmm.
And when I talk about runway, you need to have certain clarities, and you need to factor in the things where you will be spending money.
Okay.
So essentially you will be raising somewhere between 18 to 24 months of your runway,
Okay.
right, to have that much runway,
Exactly.
so that you can focus more on your business rather than just meeting investors, and
Yes.
you can focus more into growing your business.
And the
Because a
actual
lot
business.
of
Yeah.
yeah because a lot of time gets occupied in the fundraising process. So again, coming back to your question as to if a founder has used up the funds that he has
Yes.
raised and now again is looking to raise further funds, is that where a bridge round happens? Yes, that is exactly where bridge round happens. But the actual reality is, in the bridge rounds you may be looking, or you may have to approach angel investors
Okay.
or the smaller investors who might, on the basis of your previous traction, might invest in you.
Okay.
Because VCs, as you say, that VCs, how do VCs look at that? Because if you approach a VC, he will not be very happy about it,
Exactly. Yeah.
because he can very much witness that, okay,
Yeah. Same thing will happen again in the
the
future.
same
Yeah.
thing might happen again in the future. Exactly,
Yes.
absolutely. So this is not a good sign,
Exactly.
because founders, although can make mistakes and do make mistakes, they learn from their mistakes.
Yeah.
They even pivot at times,
Absolutely.
given the market conditions, dynamics, everything changes. But essentially, if like this entire comparison of 18 to 24 months versus 3 to 6 months,
Got it.
there
Yeah.
is a substantial difference. So if
Yes.
that
Yes. Yes.
happens, then you might have to raise a substantial bridge round, which then is enough for you to survive for the next 12 months.
Yes. So the next question is, what are the common mistakes the founders are making right now while raising fundings?
Well, this is an interesting question, because there are a couple of repeat offenders over here. The very first one, I would say, is just thinking about valuations. And it is a very interesting take, because see, what happens is, even if you are getting a really good valuation,
Okay.
but if it is with the bad terms, that can break you,
Okay.
right? So even if you are getting not a higher valuation, but it is with good terms, that can make your company. So it's like a make or break point. So that
Understood.
is one of the factors where a lot of founders do not make the right call,
Okay.
or like fall short of in the judgment, right? So that is one of the factors. Second, as usually I say, a lot of founders still rely on, these days, more so often on chat gpt and google baba. See, google baba and chat gpts are not going to come and save you
Exactly.
once you have signed your agreements and term sheets. So it becomes very much important for you to get your documents properly vetted by
Yeah.
advisors, your lawyers, and have a clear understanding of what you are signing up for.
Exactly. True.
Because essentially, then it's like the train has left the station, and
Yes.
now you're looking to solve things. You might end up spending more time, energy, and money
Yeah.
into it. For instance, there was this like there are a lot of tools these days, right? So a lot of startups, or like a lot of companies, a lot of founders, they get they get a lot of their compliances done through such portals,
Yeah.
like even for a trademark, for that matter, right?
Yes. Yes.
So they do it at a really affordable rate, like
Correct.
₹1,000 or
Yeah.
something, right? But essentially, I have witnessed one of the founders, essentially around 1.5 years later, they got to know that a proper trademark search was not done,
Oh,
and the same trademark was already in
given to someone.
use
Okay.
and was uh, by a very much bigger brand.
Oh.
Then he had to spend around 40 to 50 lakhs rebranding his entire business model.
Okay.
So you understand the difference.
Got
Like
it.
it is of utmost importance to have the right set of guidance and right set of people who can guide you through this important steps where you are beginning. Uh, the another mistake that founders would make is, I would say, raising too much capital,
Okay.
right? So
Raising too much capital is a good thing, right?
no, that is a bad thing.
Okay.
See, if you are raising too much capital uh, right now, because see, the actual journey starts after raising.
Okay.
Raising funds is not an achievement.
Hmm.
At the end of the day, it's a debt.
Correct.
Like even if it is an equity
Equity,
investment,
yeah.
it is
Though it
something
is
that you
like,
have raised, but that right after you have raised money,
Mhm.
that is where your entire journey starts,
Mhm.
where you start to focus more on your business and to grow.
Yes,
Now if you have raised more money, essentially you would have diluted more.
exactly.
And if it is at a very early stage, have you planned enough for series A, series B and beyond? Essentially, I have seen a couple of founders ending up with only 18 to 20% by series A because
At
they
Series
raised too
8,
much capital.
at the pre-seeds.
Yeah, at the
Okay.
pre-seed, at the angel, and
Mhm.
then they did bridge rounds,
Mhm.
which then after getting converted got diluted. The founders got diluted more,
Okay.
right? So they raised too much capital too soon, and when they actually needed money for growing their business further, it
Then
became really difficult because with
exactly.
20% now there's hardly any equity left
Equity
with the
to lose.
promoters themselves
Yeah.
to dilute, right?
True.
And then even if the valuation has gone up
Mm.
like substantially, only in that scenario you'll be able to raise good money
Yes. Yes.
at a
Yes.
higher valuation, which is not the case these days.
Yeah. Yeah.
It
Yeah.
used to be case back in 2019, 2020, but not anymore.
Correct. True. And
So I think this was the third mistake that founders.
this third mistake was very much interesting, actually.
Yes,
So, one thing which you have mentioned is the term sheet,
correct.
which many like. In fact, I was curious to know what is it.
Hmm.
And once when we raise funding and everything, we'll be getting to know what is term sheets and everything once when we are signing up.
Correct.
But to the people who wanted to know more about the this funding life cycle and everything, if you can explain the term sheet, what does it mean and what are all the things which we have to
Sure.
look into it to do
Right,
it?
right,
Yeah.
right. Essentially, a term sheet is a broad level document
Okay.
which captures the how the transaction is going to go through, right? So the nuances, the your rights, essentially investors' rights, promoters' rights, obligations.
Okay.
So it's a document which outlines the high level transaction guidelines. It can be, and more often than not, it is a non binding document, but it guides how we will move forward with the transaction. Now, coming to the important clauses, see, it is going to be having all the sets of transfer restrictions, maybe your right of first offer, right of first refusal,
Yes.
tag along, drag along, all of those things. Then it is going to capture vesting schedules like promoters lock in, all of those things, exit mechanisms,
Yeah.
like in brief. So, this is a very brief document
Okay.
which is then exemplified into a larger document that is a shareholders agreement,
Yes.
right? So that is where we deep dive into every little clause and we outline each and every detail to make sure that everything is covered completely and holistically
Understood.
to ensure the interests of both the parties are balanced
Okay.
enough.
Okay. So according to your third mistake thing, what our common founders are making. So how can you decide that this is the amount which you wanted to raise, and how much is the percentage of equity which I wanted to lose it right now? Because at that stage, right, pre-seed or before that, they'll be not sure of what is the current
Correct.
valuation first thing, and
Yes.
they'll be not having much more on the clarity on the unit economics to decide that this is my valuation. So at that time, how can they decide that this is the equity which I have to lose it out for
Okay.
the substantial rounds?
These are like two linked but still a little bit different questions altogether.
Okay.
See, first of all, how much to raise, and then comes how much to dilute.
Yes.
Okay. Like how much to raise, as I said, already mentioned that 18 to 24
24
months
months.
of runway you
Yes.
need to have. So you need to ensure that, okay, these are the expenses. Maybe your employees, your marketing budget,
Yeah.
then your development, if at all, that is it completely depends on the business model as well.
Correct.
If the tech part is there or if R&D is required. So all in all, if you are taking into consideration all the key factors,
Okay.
right, then you need to have at least 18 to 24 months of
Runway.
runway. That is the first,
Yes.
that will give you the
How
rough
much
idea
to
of how
raise?
much you'll have to raise, how much you'll require. Because see, again, you would not want after 6 months or a year to again go after investors and
Yes.
VCs, right? Second, how much to dilute.
Yeah.
Now, this would depend. Like if you are raising how much you require for 18 to 24 months.
Okay.
Now, the valuation is something that is going to be decided commercially between the promoters and the investors.
Correct.
But a promoter should be ready to dilute at least 10 to 15% initially. At times, if you are getting the right set of investor, and
Investors, yeah.
by right set of investors, I mean an investor who has strategic importance as well in your business,
Got it.
not just a financial investor, but also a investor who will provide you what you require right now to grow your business.
True.
You should be ready to even dilute 20%, but anywhere between 10 to 15 is a market standard. And that is something that is going to be expected out of founders if they are raising at least for 18 to 24 months.
The answer to the question for how much to rise is basically 18 to 24 months runway,
Correct.
and how much to dilute according to the market standards it is 15%.
Yeah,
But still,
like
yeah,
there's still no one answer. There's no
correct.
So
Yeah,
it is going to completely
based on
depend.
the investor who is coming on
Investor who
board.
is coming on board, what is he bringing onto the table, what stage the company
Yes,
has
yes, yes.
reached, a lot many things, and of course the negotiation that is going to go down.
Got it,
Right.
got it.
And also more often than not, it is also a gut feeling and market
True.
dynamics, right? So what sector your business is in, and what are the market dynamics and gut feeling about this particular thing.
Yes, yes, yes.
So that all of these things combined comes down to the fact that okay, this is how much you are going to be diluting.
Okay. And when we talk about the negotiation on these particular things, for example, a 25-year-old or 20-year-old founder sitting on opposite to the bench
Correct.
of VCs discussing this particular thing. So obviously VCs will be trying to get more percentage of equity, and on the other table, a founder may not be comfortable in losing out more than 35% or whatsoever, like that kind of a bigger chunk of an equity. So for these kind of a situations, will you be able to guide the founders, or will you be able to represent the founder on behalf of them in negotiating?
Absolutely, absolutely. Because see, essential, but there are two sets of differences over here, right? So more often than not, founders come to us once they have signed the term sheet, or once they are negotiating the
Okay,
term sheet, right? And this is the major reason and the major pitfall, right? If you are coming after you have already signed the term sheet, there is
Nothing to do with
nothing much that we will be able to do.
Yes.
Of course, we'll be able to negotiate and get you the right set of terms in your legal documentation.
Understood.
And of course, being a non-binding document, a term sheet,
Yes.
will of course renegotiate a couple of items. But essentially, the valuation and the other pieces, if you have already agreed upon, there is nothing that we can do. But essentially, if you come to us while you are in the process of pitching to the investors,
Okay.
we would guide you through. We'll give you a clarity and an idea of okay, this is how you should approach it. This is how you should get prepared for it, and this is what are the things that you need to keep in mind. Accordingly, then you will have certain things and certain clarity in your mind when you're approaching the investors and when you're pitching to them. Once you have those set of clarities and an idea around and these are not like generic things that that you will read about and you will get to know.
Yes.
It is going to be different for different sets of businesses, right? So once you have good advice,
Yes.
then you approach the investors, and you can have your lawyers as well with
Got
you. But you will be having your own team of like your CA if
Yes.
he is there with you for the financials and other things. If you have a lot of it sorted, it's not a very difficult thing to finalize upon. But see, the initial conversations that you're going to be having with the VCs, with the
That is the-
established VCs, that is something that you're going to have on one-on-one.
Okay. Yeah,
That is where
true.
lawyers will not be
Yes.
there, right? So you need to be prepared beforehand. Once
Understood.
you're prepared beforehand, the conversation may not be as tricky or
Correct.
as difficult to have, because you will be prepared that okay, this is what they might ask, and this is what they might be looking for, and this is how much I am ready to, right? So if you have a bit of idea, clarity about all of these things, it makes it a little bit easier, is what I can say.
Sure, sure. So you'll be making that particular founder equipped to go for a war.
Correct. Absolutely. Having the right set of ammunitions
Correct.
is very important.
True. So, and the next thing is we'll talk about this convertible loan agreement thing.
Correct.
So we are not comparing which one is going to be better. So the difference between the equity round and then the convertible round.
Okay. So this is interesting. Like, and also the reason why bridge rounds are convertible rounds. See, there are two aspects to it. First of all, convertible rounds. Why do founders or startups go for convertible rounds? As I stated, they go for it because either they have run out of money and they need cash quick.
Okay.
See, priced rounds are time consuming process.
Correct.
right? They are lengthy processes.
Yes.
You'll have your SHA, you'll have your SSA. There might be due diligence that is going to be conducted on the company because of the valuation that is going to be fixed, and a lot many things are going to happen. So it takes approximately anywhere between 1.5 to 3 to 4 months
Correct.
for a price round to get completed. Where in a convertible round, it's quick,
Yeah.
because you don't have to worry about valuations and everything. You can defer it. That is exactly where convertible round comes into the picture,
Okay.
where founders are looking for cash quickly, and they don't have to worry a lot about the valuation of the company,
Okay.
because that is something that is deferred at a and is connected to a future round of financing.
Understood. So this is like a immediate result, which is coming in
Immediate
to help.
resolve.
Yeah.
Yes, yes, yes. Now coming to the equity financing round,
Mm.
or like price round, that is where investors get equity and shareholding in your company from day one,
Yes.
right? In convertible, they don't get the shareholding right away. It is once it gets converted based upon the milestones, and based upon the timelines and the terms of the convertible loan.
Okay.
It varies from like a valuation floor, valuation cap, anywhere
Yes.
between that. So all of those things are going to come into play.
Understood. So can you please explain what is convertible notes?
Okay, so convertible notes essentially are different set of instruments that company issues to raise funds,
Okay.
right? These are much quicker than raising price rounds, and this is something almost every founder
Okay.
will go through essentially if while building their businesses, because they would at some stage and point in time require funds immediately, right? So essentially what you are doing is you are uh, raising funds, and against the investment you are issuing a convertible note, or
Okay.
a convertible instrument, and that instrument is going to get converted to equity or preference shares only upon occurrence of xyz events.
Okay.
Okay, and those events can be like are termed into that particular document. Now also it is you'll ask about the valuation. So
Yes.
that is where we just like put a valuation floor or a valuation cap. Now what a valuation floor is, like the minimum valuation,
Yes.
and valuation cap is the maximum ceiling valuation that is going to be there. So it is going to convert either at the valuation floor or valuation cap, or it's somewhere in between that.
Yes.
Now this is going to be linked to the next equity financing round
Correct.
that the company is going to raise essentially. So right, like as the name suggests, it is like a convertible instrument, right? So you are deferring the finalization or crystallization of the valuation of the company at this stage. It
Okay.
gets finalized only upon occurrence of a particular event, that is the next set of equity financing round.
Okay. Very good. Very good answer. So that is it about the founder's perspective. So we can now switch the questions back to the investor's perspective.
Absolutely, absolutely,
Yes. So yeah, let's jump into investor's perspective set of questions.
absolutely.
Yes. The first thing is, what does investors or VCs looking forward from the founders? So are they really wanted to invest on the idea, or are they wanted to invest on the founders themselves?
Interesting question. I would say, as per my experience and what I have seen across in the startups ecosystem, it's somewhere 60 to 70% founder
Okay.
and 30 to 40% about idea.
Idea.
Yeah, because essentially for VCs and investors, uh, they are more often than not essentially investing into the founders,
Okay.
because they see if the founders are resilient,
Hmm.
if they are adaptable,
Okay.
right, and if they are quick decision makers or not.
Understood.
Because in the as per the changing market dynamics, they need to at times pivot.
Mhm.
They need to take quick decisions. They
Understood.
need to scale fast. So in this entire like process of building up one's own venture, it is a very very tiring process.
Mhm.
Whether a person is would be able to go through hell and survive and still make it big,
Got it.
right? So
Yes.
that is a skill. Even if you have a great idea, but you would require a really great team
To
to
execute.
execute it properly. And this ecosystem has witnessed time and again great ideas falling apart, but even the very common ideas, or even the copied ideas,
Are making it
working
big.
out really
Yeah.
well and turning into unicorns.
True. 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 That
So
is there.
essentially that is what it comes down to.
Okay. providing your experience about so and so years in this particular industry. So how the funding has been evolved over the landscape period of say 5 years from now, has it been evolved into a bigger thing, or right now also founders are facing issues in raising fundings? What is
Correct.
your point on that? Yeah.
Well, if we look back and compare it with how things are going today, uh, there is a lot of difference.
Okay.
There's a lot of difference for that matter. If we look back from period between 2015-16 till to 2019, okay, so that was that era of startup culture wherein it was like growth at all costs,
Okay.
right? So VCs were investing in a lot of startups and everything was going well.
Okay.
Then came the pandemic boom,
Mm-hmm.
right? So like 2020 to 2021.
Okay.
So this 2 years changed a lot of things, changed a lot of dynamics, because it technically it was that era, that time of startup ecosystem wherein if you had a pitch deck,
Okay.
if you have a company running, you will get capital.
Oh.
It was as easy, insane valuations.
Okay.
Investors were putting in money left, right, center, writing checks. Then came the correction period.
Okay.
Like from 2022, it became more of like a
Authentication kind
reality check.
of. Okay.
Now it's not no longer about how good your idea is, and now investors are looking for sustainable business models.
True.
Sustainability has come into the picture. Why? Because they have seen a lot of startups failing bad, even after having and attaining insane valuations.
True.
Right, and have seen a lot of, and this has also to do with a lot of founders not keeping in check the
Yeah.
compliances of their companies, right? Like the good governance side.
Correct.
So the good governance has become more so important now. How the founders are conducting their business, right? It's no longer about that, okay, if they are able to show numbers on their financial statements, they are going to get fundings. No. It has now come down to sustainable business models and having a good governance. How is your relationship with your existing investors? All of those makes a lot of difference these days. So right now we are into that patch where still people say like the funding winter has never ended. It's still going on, sort of. Things have started to look a little promising, even if you compare the charts like past 3 weeks, especially in the month of February and the last weeks of January. The funding, the number of deals, the transaction size have increased a lot, but still it's still not as good as how it was back in 2020 and 2021.
Okay, this is a good insight actually. So,
Yes.
from my understanding, right, consider a person who is very good in technicalities,
Correct.
and he has his idea of his certain way of idea of making the environment in a better way using AI, using his technicality skills and everything. But when you consider these kind of founders, right, when they wanted to go sit in front of the VCs, so they obviously lagging certain kind of skills. So at that time, it's more than idea or more than about the execution. It is just the conversation which we are having with the VCs from the technical perspective. So those kind of founders are really facing the struggles right now. So that is my way of thinking. So any inputs on that?
Well, see, there is always a person who is going to be good in one particular sector in a startup, right? And that is why it is very important to have the right set of co-founder.
Okay,
A co-founder who complements you,
understood.
right? A person who is coming up with skills which is complementing the skills that you already have,
Okay,
right? So it's not essentially that, okay, sometimes you must have seen that, for example, take Theobroma, right? They were really good at the skills
okay,
of what they were doing,
correct.
of the business, but still they chose to hire a CEO.
Yeah,
And that CEO ran the company, raised funds, and made it such a huge
a
brand.
success story. Yeah,
And today we know it as a really good success story,
correct.
$1 billion company and whatnot, right?
Yes, yes.
So that is what is of utmost importance. If you think that what you are good at, you should focus at that thing,
Correct.
and maybe have a right set of co-founder who complements your skills and qualities,
Correct.
who can take the business up and
Up
forward.
forward, yeah.
Because essentially you need all the wheels, right? It's not like the one wheel, like even if you have a great tech founder,
Yeah,
right, but if you don't have the other business acumen to grow your business, it may not work out. Similarly, if you have right sets of business acumen, business idea, everything, but you don't have a tech person to like develop what you have in your mind, or
Yes.
what your vision is, right? So it may not be possible.
Correct.
And that is where the dynamics between founding team members is very, very crucial and important.
Yes.
It holds a lot of importance
Okay.
as to how your startup is going to be shaped in the coming years to come.
Yes. So it is mostly about whom we are coordinating with, and the example which you have cited is also like a very better one. So
Correct.
in these kind of scenarios, it is like we are good at doing something, and we need some other helping hand. So it is like
Correct.
seeking an advice and seeking an help and taking the things forward.
Correct.
So
Correct.
that would
Correct.
be solving these kind of
Yes,
issues as
yes,
well.
yes. And
Yes.
it is like as a founder, you would also agree with this. It is a role that you are never prepared for.
Correct. True.
A lot of things you learn on the job.
Yes. Yes.
A
Yes.
lot of things you are figuring out on a daily basis.
Exactly.
If
Yeah.
not on a recurring basis, I would say daily basis, you are
Yes.
figuring
Yes.
one
Yes.
thing, this thing, that thing. So a lot of things you will learn, you will evolve, you will grow
Yeah.
eventually, right? So you will reach there, you'll be there, right? With the right set of people, you'll reach there sooner.
Exactly.
You'll grow multifold
So
and
person will be
sooner.
concentrating on the business, and
Correct.
this guy will be taking care of the
Yes.
separate role.
So
Yeah.
that is where you and having the confidence of the co-founder, like you're not worried about that. Okay, this is something that he's going to take care of.
Yeah.
You don't need to even deep dive into that. Even
True.
just having a small conversation and being updated about what is going into that particular department
Mm-hmm.
is going to be well enough,
Correct.
right? So that is how it is going to work eventually, because even like a lot of founders who has made it big, somewhere they started with a team of 2-3 people,
Yeah.
right?
Yeah.
But essentially they grew multifold, they grew in a really good manner,
Yes. Yes.
and they're sustaining well because of the fact that they had the strong arms helping them.
Mm-hmm.
So I think that is of something that is every founder should keep in mind.
Yes. Now the common question is, if you wanted to give a piece of advice to a early stage founders, what could it be?
Well, I would say
Don't tell, just don't start.
no, absolutely not. Having to build a venture of their own is a very big task in itself. And one piece of advice that I would give, based on my experience, would be like, mm, to not focus a lot on the valuation, and focus a lot more onto what you're building and the customers or clients that you may have, right? Because lately what has happened, it has become a norm that everybody is raising that, chasing that particular number, that okay, we have raised 5 million, or we have raised at so and so million
Yes. Yes.
dollar
Yes.
valuation. While all of those things are going to be good and would be helpful for you, but the essentially the struggle would begin once you have that money in your bank account, and how to run your business and how to focus on the things that are of utmost importance. Because once you have that, you are also somewhere answerable to certain set of
Correct.
people,
Yeah.
right? So I think focusing more on the business model and customers,
Okay.
right? And like raising funds is a part of the process of growing your business, but not the
Entire
entirety
journey.
of it on.
Understood.
So I think
Yeah,
that is
sure.
something.
And second thing is, what is the one common myth in the VC's particular circle that you wanted to debunk?
Myth that is again a very similar point, but I would like to reiterate it and I would like
Yes.
to paraphrase it, that raising funds is equivalent to success, right? uh, it has been glorified to another extent,
Okay.
right? uh, like people, you start to get traction, you start to become validated, and of course that's a good thing, and that will boost your confidence. All of it is good, but it is not equivalent to success.
Understood.
It is at the end of the day money that you has come in and that you need to put into good use,
Correct.
to make sure that you are running a sustainable business eventually, and that you are able to make good profit, and you are able to grow your business essentially. So I think, yeah, that is a myth, that raising money, the
Is
higher
not
you raise
equal.
or at a higher valuation you raise, is not equivalent to success.
Okay, that is a very good answer. Yeah, that's it. I mean, we'll wind it up. So before that, if any of the young founders who is watching this video, if they wanted to get in touch with you, you can let us know where they can reach out to you.
Well, by and large, to the larger audience out there, if they want to reach out to me, I'm very much active on LinkedIn, and I try to reply to almost all of the queries and messages that I get. So they can reach out to me there, and we can take it forward from there. We can have a
Sure.
fruitful, real, meaningful conversation if they are looking for compliance related assistance or any legal sort of assistance, startup fundraising.
Sure.
So they can reach out to me via LinkedIn.
Thank you so much for coming and being the part of Hi and My podcast.
It was great having a
Good time, yeah.
good time and meaningful conversation with you around navigating the fundraising
Yes.
and startup ecosystem. I hope what everybody has seen, it was meaningful for them as well, and
Yes,
they
of
it
course.
was
Yeah.
insightful. So yeah, thank you so much.
Thank you so much. Yes.